Andrew, saving money on our power bills, and that's why we're talking about your money this morning. Andrew, thank you. Joining us this morning, our financial expert, Mark Gravicheski. He is from the Quad Cities Investment Group. Always good to have you along.
Good to see you again. It's Wednesday morning, a little bit of a different day for us, but I completely understand why we switched it from Monday to Wednesday.
We have to talk about the cooling housing market. I know the August report is supposed to be coming out today, but all you have to do is take a temperature right now. I think across the country, it is cooling because of these interest rates.
It really is. And it really all ties back to this very, very high rate of inflation that we're seeing. To help get this inflation under control, the Federal Reserve is aggressively raising what's called the benchmark Fed funds rate. And by raising the Fed funds rate, it effectively influences many other forms of consumer debt. And, think of credit cards and bank loans, auto loans, even home mortgage rates. And when the Federal Reserve raises interest rates, it makes it more expensive to buy things on credit. You're now going to be charged a much, much higher interest rate to borrow that money. And the Federal Reserve hopes that by, raising interest rates, it reduces consumer spending, puts a little bit of downward pressure on prices, because if prices get too high, people can't afford to buy things anymore. And that's exactly what we're seeing in that housing market. Home prices are so high, people are effectively being priced out of being able to buy a home.
We're talking about, I know I'm putting you on the spot here with numbers, but numbers is your game.
Yep.
That's your what you do. We're talking 1 percentage point. That's hundreds of dollars when you're talking about a mortgage.
Yes. When the Federal Reserve raises interest rate, it influences, so many other forms of consumer debt, especially mortgage rates. And the Federal Reserve is expected to have a meeting this afternoon around 1:15 to raise that benchmark Fed funds rate, maybe 0.75%, another 1%. Now, mortgage rates, the 6% we're currently seeing in the home mortgage rates average, that's kind of baked in. The concern on the home mortgage side is the action. What potentially is the Federal Reserve going to do in the upcoming meetings later on this year, the first part of 2023? The Federal Reserve is still expected to aggressively raise interest rates over the next 6 months.
So over the next 6 months, you're talking about even higher than the 6% we could be seeing right now with home interest rates.
A lot of it, Ann, depends on how the path of inflation pans out. I want everybody to focus on this 3-month window here of mortgage rates. Now, from mid-June to mid-August, and we did see this sharp drop in mortgage rates on the hope that, maybe inflation had peaked and we'd continue to see this steady decline in inflation. But over the last month, and we're seeing more and more evidence that inflation is going to remain historically high for quite some time, and that means that the Federal Reserve will have to keep aggressively raising interest rates over the next upcoming meetings throughout the course of the year and into early 2023. That translates to higher interest rates. As for my outlook, Ann, I think if inflation continues to rise, there's room for mortgage rates to continue to go higher. If inflation starts to decline, or we start to see, some of those recessionary clouds on the horizon, certainly mortgage rates can start to pull back. But the fate of mortgage rates and the fate of inflation are kind of closely tied together.
And it doesn't only affect people that potentially want to buy a home, or if you're already a homeowner, this affects renters as well.
You're absolutely right. We focus so much on homeowners, we kind of forget sometimes about the renters, but renters have been facing their own set of challenges. Over the last 12 months, rental prices have increased by 6.7%, which is the largest annual increase in rental prices in about 42 years. And because these mortgage rates have been soaring, it effectively prices people out of the housing market into the rental market. And because you have so many people now looking to rent, it inherently pushes those rental prices even higher. And that's why they're expecting rental costs to increase by yet another 7% or so over the next 12 months.
And I've read in some parts of the country that's up 12%.
It is.
So 6 and 7% around here, we're pretty lucky.
Bigger cities typically have those higher percentage increases. So hopefully here in the Quad Cities, it's not as high.
All right, Mark, always good to see you. Thank you for joining us.
Great to see you again.